Another interest rate hike on the way. A lot of people across all markets kind of freaking out. The biggest interest rate hike since 28 years ago, potentially. What's going to happen to crypto markets? What's going to happen to the stock market? What is up, everyone? Welcome to Crypto Capital Venture. Hit that like on the way and let's just jump into it. This is a 30-year fixed rate mortgage average in the United States. You can just see the gains. The interest rate gains on the way up and going to continue in that on that rise this year and tomorrow, being a really big deal. I want to try and take data from previous years, previous cycles, and collectively bring it together to get a more healthy picture than these one-liner headlines that we see. I'm the type of person that you very much know, I'm extremely conservative and I'm always prepared for downside. I'm always prepared for the worst case scenario. It's a huge part of my plan in these volatile, risky markets. But I don't dwell in it. I can't dwell in the doom and gloom because first off, it's too much emotion in that mindset and in that world, and it's just not worth it. Anticipate that things could really get terrible and plan around it. But why sit in that when we don't know exactly what's going to happen? And I want to try and bring some reality into the situation. Interest rates on the rise for sure. We have this headline, the Fed's biggest interest rate hike in 28 years could be coming. And we're going to dig into that headline. Higher rates make borrowing money more expensive and encourage companies and people to borrow less and save more. So they're just trying to get people to borrow less money, to spend less, slow down inflation, and we're going to see if that works, right? That's the goal for this to happen, to lessen inflation. But let's rewind for a second. The Fed's biggest interest rate hike in 20 years could be coming. A lot of the doom and gloom, a lot of the fear that we're seeing comes from headlines like this. And the question is, though, what's behind this headline? Well, what were the interest rate hikes in 28 years ago looking like, and what did it do, right? It's going to be just as bad potentially tomorrow in terms of the interest rate hike. Well, what did it do then in 28 years ago when it actually happened? Let's look. S&P 500 index. This is what it did. This is what it looks like. 1994. There's the drop because of the interest rate increase. We're looking at around an 8% decrease. But look what happened months after. This is a monthly chart. It went on to new all-time highs. Now, this isn't me saying this. We're going to get a similar type of deal. There's other things going on in the world right now and in the economy right now, and we have to pay attention to those things, right? And we already seen we've gotten a bigger dip than this already, right? But this is some perspective. Just because we're getting a similar raise in interest rate hikes, there's more going on, and I wanted to dig into this even a little bit more, right? So this is the 30-year fixed mortgage average, right? Check this out. Here's where we are right now, coming out of these like record lows. This was 1994, the interest rate hike. They went up to 9%, and you can just see we survived. And not only did we survive, you can see the traditional markets, S&P 500 index here, went on to new all-time highs. Now, I want to take another piece of data here, and I actually want to go to unemployment. In 1994, when all this was happening, biggest rate hike since that we've seen in 28 years, what happened then with unemployment? What was going on then? It was at 5.5% unemployment. Where are we now? We're at 3.9%. Here's an article from today. Americans have gone back to work. Now we can move towards steady growth. There are pieces to the story that are positive. There are pieces to the story that are healthy, that are good, that are better than they were 28 years ago when traditional markets recovered and went on to new all-time highs. Again, I'm not sitting here saying that's what's going to happen, but when we start looking at this chart, right, we really start getting more perspective on, okay, here's our consolidation so far, and it's been pretty big. How doom and gloom is it going to get, though? That's the question. And then I want to bring this in for perspective. This was tweeted a little bit earlier today. No joke, the mortgage rate hike, sorry, I was fixing my screen. The mortgage rate just hit 6.28% today, beyond words to express at this point. And this guy replied, and he said, it's just such good perspective. My first mortgage in 2004 was 6.25%. We need some perspective. It's not the end of the world and likely leads to a healthier housing market down the road. And there's a lot, I think there's, if I remember correctly, there's a lot of comments like this, kind of bringing in some reality, some perspective. You can look at one piece of the story, which is just the picture of what's happening, the rising interest rates, and just say, oh my goodness, it's over. Like, you can do that, but what's the point of doing that? That's not all of the data. And again, we don't know how bad things will get. I haven't even mentioned there's a really big deal with this war in Ukraine, right? It's a huge deal playing a part in this. And so things could get worse, but I think we need to just take it one day at a time and just analyze daily what happens and how quick does inflation respond to everything that's being done. I think there's so much to the story, and especially that a 10-minute video that I'm doing right now can't even cover. I'm just doing this video, though, because I think we shouldn't be so quick to doom and gloom. And the other thing I should mention, actually, is if you think about it, this guy's first mortgage was in 2004 at 6.25%, right? We're in a way better situation than we were from a mortgage perspective, housing market perspective, than we were in 2004. 2004 was literally, that was the ingredients of the entire housing market crash that happened. All back there in 2004 was the buildup to what we saw happen on the traditional market charts right here. This buildup was mortgage companies giving these mortgages to subprime borrowers that should have never had a mortgage, just no regulation in terms of the lending that was going on. And this is what caused this. In terms of the housing market, there, I think, will be consolidation. There could be some slight correction, but I think a lot of people are thinking we're getting like this housing crash that we had back then. And I just, in 2008, and I don't think that is in play right now. And I don't think it should even be part of the narrative right now. The lending that's been going on recently, with rising inflation, is nothing like what was going on back here leading into the housing crisis that happened. So we need to take that into perspective and stop just creating these headlines that creates all this fear. And this is not financial advice, everybody. I'm just a guy out here speaking from experience, right? Speaking from the data that I've analyzed. And it's not financial advice, but it's just data that I think we can find useful as we navigate our way to finding this bottom, wherever that is, and however weeks or months away it is. But I think we're on our way. I really do. It's been downside for traditional markets. It's been downside for crypto markets, as you see, Bitcoin in its own cycle to the downside, and it could very well continue. But at the same time, in this roadmap, and you watch my last Bitcoin video, these targets have been hit almost perfectly that we've had for years. On this chart, Bitcoin looks very commonplace right now, even amidst all of the chaos that's going on right now. So yeah, let's watch what happens, but at the same time, let's have a healthy perspective of what actually is going on and all of the numbers and all of the data points that revolve around these things. And there's a lot that I'm missing too here. Like, there's a ton of other things going on right now that I could draw into this conversation, but I just wanted to just talk through that a little bit because I think these are some important numbers alone. We'll see what happens tomorrow. It's a big day, obviously, to see the rate increase. May 5th, 50 points. March 17th, 25 points. Is tomorrow going to be the day? A 75-point increase. Time will tell, and we're going to just see and watch how markets react to that happening. All in all, everybody, I say this time and time again, I think the Band-Aid has been ripped off, and now it's just a matter of getting through, plugging away through the formation of this consolidation, the formation of this bear market. Let it play out. Have your plan. Be very careful out there. Could all the doom and gloom last just so long, like some people are saying? Maybe. Be prepared for that. Have that as part of your risk analysis, if you will. But let's take it one day at a time. And as always, time will tell. We'll see what happens. I appreciate all of you coming by. Hit the subscribe if you're not a subscriber. I'll see you in the next video. God bless.